Ever wondered how Warren Buffett became one of the most successful investors in the world? It wasn't by chance, but by following a set of principles that guided his investment decisions. Today, we'll delve into these 7 rules that have shaped Buffett's financial journey. As simple as these rules may seem, many tend to stumble when applying them. Often they get caught up in the intricacies of the stock market, or they try to time the market perfectly, only to find that their investments are not yielding the desired results. Now, this isn't because these rules are flawed, but because they're not understood or applied properly. But if I tell you that these issues can be overcome by understanding and applying these 7 rules effectively, would you be interested? Stick around as we unravel the wisdom of Warren Buffett and how you can apply these rules to become a more successful investor. Suppose you believe that investing is all about money. That's a common misconception. The truth is, investing is as much about learning as it is about earning. The more you learn, the more you earn. Now, let's tackle the misconception head-on. Many people think they can just throw money at investments and watch it grow. But the reality is, without a solid understanding of what you're investing in, you're essentially gambling, not investing. So, how can you overcome this? The answer lies in continuous learning. Read financial news, delve into books about investing, attend seminars, or even take online courses. The world of investing is vast and ever-changing, so there's always something new to learn. But why should you invest your time in learning? Here's the payoff. When you understand the mechanics of your investments, you're better equipped to make informed decisions. You'll be able to assess risks, identify opportunities, and ultimately increase your potential for higher returns. Remember, the most successful investors are those who never stop learning. They understand that knowledge is power, especially in the world of investing. They don't just grow their money, they also grow their understanding, their insights, and their skills. By investing in your knowledge, you're paving the way for better investment decisions. Suppose you think investing is just about picking stocks randomly. That's where you're wrong. Investing is not a game of chance, it's a game of knowledge. It's about knowing what you're putting your money into. Let's dispel a common misconception right off the bat. Many believe that investing is all about following trends or jumping on the latest hot stock. But that's a risky strategy. What happens when the trend changes or the stock cools off? You could lose a lot, and fast. So, what's the effective strategy to overcome this problem? It's simple. Know your investments. Understand the products or services a company offers and how it plans to make money in the future. This means doing your homework. Read the company's financial reports, follow news about the company and its industry, and understand its business model. Now, this might sound like a lot of work, and it is. But it's necessary work if you want to be a successful investor. The more you understand about a company, the better equipped you are to make informed decisions about whether to invest in it. And how is this strategy beneficial for you? It reduces your risk and increases your potential returns. By knowing your investments, you can avoid companies that are unlikely to succeed and focus on those that have a solid plan for growth. Knowing your investments is like knowing the rules of the game. It gives you an edge. Suppose you only focus on investing in big, established companies. Is that the right strategy? Now, it's easy to think that the bigger the company, the safer your investment. But let's flip that coin. Small companies often pack more potential for growth compared to established giants. They're hustling, innovating, and breaking barriers, which can lead to higher returns over time. So how do you spot these budding stars? Look for companies with strong leadership, a unique product or service, and a clear vision for growth. But remember, due diligence is key. Research their financials, understand their market, and keep an eye on their performance. So why consider small companies? Because they can turn into tomorrow's big winners. They offer the chance for higher growth and can add a dynamic element to your investment portfolio. Remember, Rome wasn't built in a day, and neither are corporate giants. Small companies can be big opportunities, don't overlook them. Suppose you own shares in a multitude of companies, but can you keep track of them all? This is a common pitfall for many investors, spreading themselves too thin and losing sight of their investments. It's like juggling too many balls at once. Eventually, some are going to drop. Here's the secret sauce. Focus. Don't invest in more stocks than you can keep an eye on. Being informed about your investments means knowing the ins and outs of the companies you invest in. It means following their news, understanding their financials, and keeping track of their performance. There's an array of tools and resources out there to help you stay informed. From financial news sites and stock market apps to company reports and investor forums, knowledge is at your fingertips. Remember, being informed is more than just knowing your investments, it's about understanding them. It's about making timely and informed decisions based on that understanding. After all, staying informed is staying ahead. It helps you make timely decisions. Suppose you invest in a company whose products or services you don't really like or understand. Is that a wise decision? Well, it's a common misconception that you should only focus on the numbers when investing, but let's think about it. If you genuinely like a product, there's a good chance others do too. This can be a great initial indicator of a potentially lucrative investment opportunity. Now, how do you strategize with this in mind? Start by thinking about the products or services you use and love. Do you believe in them? Would you recommend them? If yes, these companies might be worth considering for investment. And what's the payoff? Well, investing in what you love makes your investment journey more enjoyable. It also makes it more intuitive. You'll have a better understanding of the company's value proposition, which can guide your investment decisions. Investing in what you love isn't just enjoyable, it's often profitable. Suppose you try to time the market buying low and selling high, but is that truly achievable? It's a common misconception that market timing is the key to success. The reality is, predicting market movements is like trying to catch a falling knife. It's not only risky, but nearly impossible. Instead, focus on identifying solid businesses with long-term growth potential. This involves understanding a company's fundamentals, its competitive landscape, and its growth strategies. It's about investing in a business, not just a stock. This approach benefits you in a couple of ways. Firstly, it reduces the stress of constantly chasing market trends. Secondly, it can potentially provide better returns. Remember, even the world's greatest investors focus on the quality of businesses, not the unpredictability of the market. Avoiding market timing doesn't just reduce stress, it often leads to better returns. So let's focus on finding those diamonds in the rough and let time do the heavy lifting. Suppose you focus only on a company's earnings. But is that the whole picture? A common misconception is that earnings are the be-all and end-all of investment indicators. However, focusing solely on them can sometimes paint a distorted image of a company's financial health. Why? Because earnings can be manipulated with creative accounting techniques, but cash flow, specifically free cash flow, is harder to fake. Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It's the real deal, the money that's free to be invested in new opportunities or to reward shareholders. So, how do you shift your focus to cash flow? You can start by examining a company's cash flow statement, a part of its financial reports. This statement reveals how much cash is coming in and going out of the company. Understanding this aspect can give you a more comprehensive view of a company's financial health. It's like getting a sneak peek into the company's cash register. Focusing on cash flow provides a clearer picture of a company's health, helping you to make better investment decisions. So, there you have it. The 7 Rules of Investing by Warren Buffett. From continuously learning to increase your earning potential to understanding your investments inside and out. From considering the immense growth potential of small companies to staying informed about the businesses you invest in. From recognizing the value of likable products to avoiding the pitfalls of market timing. And finally, focusing on the lifeblood of any business: cash flow. Each of these rules holds its own unique importance in the realm of investing, but the real magic happens when they're applied together in unison, forming a holistic approach to investing. It's not just about growing your money, but growing as an individual, as a learner, as a strategic thinker. Remember, investing isn't just about money, it's about knowledge, understanding, and strategy. So, keep learning, stay informed, and make wise decisions. And if you found this video helpful, please like, subscribe, and share it with others who might benefit.